In this video, we're answering more of the top questions from some of our favorite subreddits. So let's go. We're covering everything from how to handle market crashes, should you invest in life insurance, and what if you have no idea what you're doing? We'll talk about that as well. All right, first question here. Markets are terrible. Is now a good or a bad time to increase my monthly index fund investments? So I love this question because I think it's like what a lot of people are thinking, right? Like when the market's down, as we are here filming this in April or May 2022, people wonder how they should change, what they should do, right? It's an inclination. How should I react to this market drop or market volatility? And the reality is now is the time more than ever to not react. Now is the time to trust the process, to trust what you put into place. And for this person, maybe they have a monthly dollar cost averaging in their index fund. That's perfect. During market volatility, you're buying more of that index fund than you were when the market was going up. So volatility in that sense, in the short term, might be a good thing for you because long term, you'll own more of that investment. You'll have a lower cost basis, assuming the markets go up long term, right? So the answer to that is don't change anything. Maybe if you have some more cash sitting on the side that you were waiting for this one day for the market to drop and you feel like you're buying on a dip, great, go do that. But definitely don't pause your investments, don't change anything, and resist the temptation to feel like you need to step in during market volatility. If you want more tips like this to grow your wealth, pay off debt, and learn all the financial 101 tools that maybe we weren't all taught in high school and college, hit subscribe and follow along. Should I pause on investing? With the stock market trending the way it is now, things obviously are not looking great. I'm not planning on selling any of my stocks, but I'm considering now not buying anything additional so this so-called recession hits. It's pretty much the same answer as what should I do during market volatility? How should I change my strategy? Should I pause? It all goes in the same thing. And the answer is always the same, right? No, you should not pause investing, assuming that your time frame is long-term. The only caveat to this is if you're planning to use these funds to buy a home, let's say in the next couple of years, and you are concerned that this, recession might last for a few years and the market's going to keep going down, well, then I guess you might have to protect your principal. But in that case, you shouldn't have been investing those funds. Investing is meant for anything 3, 4, 5+ years out or more, right? Don't invest funds that are meant for the next couple of years and use this as an example. So in that case, should you pause investing? No. If you have cash sitting on the side and your time frame is still long-term, throw that money in the market. That's my recommendation. Now that doesn't apply to everyone, but in the end, times like this, choppy markets, the market's down 15, 20% for the year. It sounds scary, right? Go out 10, 20 years, the market always has these drawbacks. So what? Use these opportunities to stick to your long-term plan, or if anything, add more funds to your long-term investments. Love this question. Why doesn't everyone love crashes? What am I missing? So basically this person is asking, why don't big investors and everyone else absolutely love stock market downturns and small crashes? Well, I do. I mean, I don't really love them, but I see them as opportunities as a normal part of long-term investing. Now, a stock market crash could mean, 15, 20% down like we're seeing here in spring of 2022. It could mean a lot worse like we saw in, 2008. I don't wish for anyone to lose their life savings through a stock market crash. But as a long-term investor, a volatile market or a drawback, right, or a bear market represents an opportunity. It represents a really good opportunity to continue to dollar cost average or continue to put money into your long-term investments. Again, when the market is down or volatile, and you're consistently adding to your investments through recurring deposits, you end up buying more during those volatile down markets. We recently did a video where it looked at 3 different types of markets and what ended up giving the investor the best outcome. And the reality was the volatile decreasing market long-term, if you were investing during that, gave the average investor the best long-term outcome. You don't want to invest in just a rising market. Sometimes you don't even want to invest in just a volatile market. You want to invest in a market that's technically going down if your time frame is long. So I look at opportunities like this as great for the young investor, those with any long-term horizon. How are capital gains taxed and paid? If you sell a holding, do you have to pay any capital gains tax, even if you don't withdraw money from your brokerage account and reinvest it elsewhere? Or do you only pay taxes for what you withdraw from the account? So this is a common question. I think I've been in this industry for 10+ years. And for me, this was something I learned early on. And now when I get asked this, I'm like, well, what do you mean? And then I realized I had the same question when I first got started and I had to teach myself, right? So here's what it is. There's 2 types of capital gains tax. There's long-term and short-term. No matter what, if you sell an investment for more than what you paid for, no matter what time frame, you will owe taxes on the earnings, even if you immediately reinvest it in another security, let's say, or just let it sit in cash. So in this case, the answer to that is you will owe taxes most likely if you sold that investment for more than what you paid for. Now, the tax rate that you pay on the earnings depends on how long you held it. If you held it for less than 365 days from the day that you purchased it, you're gonna owe taxes on those earnings according to your marginal income tax rate, which can get up in the 30-40% for some people, if you look at state and federal taxes. If you held the investment for more than 365 days, you're gonna owe taxes on the earnings according to your long-term capital gains rate, which is 15 or 20% depending on your income. And you gotta factor in state taxes in there as well. Either way, you're likely going to owe taxes. But if you use a service that offers tax loss harvesting, especially on a daily basis and especially through software, you might be able to offset those capital gains every single year with tax loss harvesting. You wanna learn more about that? See the link below. Next question. Well, not much of a question here. I have no clue what I'm doing. This person goes on to say, I would like to learn the science behind investing so I can make decisions on my own and learn, like what companies are worth watching, when is the best time to buy shares, how to read graphs, expect when to prepare for the best and the worst, any other crucial information that may come with the trade. So don't be afraid. Pretty much everyone, when they first started investing, don't have any idea what they're doing. So this is very common to feel like this. Even those that have been in the game for a while, sometimes, especially during volatile markets, question themselves, like, what am I doing here? How do I react? There's a lot of questions that go into this. But the reality is there are different types of investors, right? There's just the passive delegator, or there's the person that really wants to get involved with their investments and do all the research and look at the graphs and pick out certain companies that they think are gonna outperform others. Personally, I'd rather go with what the data shows as the likely best outcome. I'd rather go with what the data has proven over the long term of the history of the stock market that's gonna give you the best long-term outcome. And that is passive investing by buying an index fund or multiple index funds that cover the global market. If you try to go in and pick individual stocks, good luck. You can read all the graphs you want. The majority of professional investors that have been doing it their whole career, if doing that, picking individual companies to buy and sell, typically over the long run, don't even outperform just the S&P 500. So you can buy the index or just the overall market, or you can go and pick stocks. If you're telling me that the professional investors who go and pick those stocks typically don't even outperform just buying that index fund, I'd rather do the thing that data shows long-term will come out ahead. I'm not saying you cannot pick individual stocks or that you shouldn't. I'm just saying data has shown us, history has shown us that passive investing through index fund in a diversified portfolio typically leads to the best outcome. How much money is a good amount to start investing with? I've saved up a bit of money over the past few months with hopes of beginning to invest in stocks, but I'm not sure how much money I should have in the market at one time. So to the experienced investors out there, how much did you start with when you first dipped into the market? Well, good news for this person is that now is a great time to start investing. If you think that the market is down and it's gonna go up in the future, you're gonna get a lot more for what you paid for here in spring of 2022. But no matter what the market's doing, last year, whether it was up, now whether it's down, no matter what, the answer always stays the same. And that's as long as you have your bases covered in the kind of your financial checklist before investing, you should invest all the funds. Don't hold them out of the market, just invest them for the long-term plan. But what are those bases, right? You gotta take care of your debt. If you have any high interest debt, anywhere over, let's say 6%, you should probably focus on paying that off first before investing. The reason is that long-term, the stock market's gonna give you right around 7-8%, let's say annualized return. That's pre-tax. After tax, assuming that you're taking your money out at some point, the market's not gonna get you better than a 6% return. Paying off 6% debt is a guaranteed risk-free 6% return if you think about it that way, right? So pay off your debt, make sure you have enough cash savings set aside as well. Make sure you have at least 3 months of worth of emergency savings and then some extra cash buffer to cover maybe a month worth of living expenses, as well as for any short-term goals. Anything you're doing in the next few years that you're saving up for, save cash for that. If you've covered those bases, you got rid of that debt and you have cash savings, whatever extra money left over that you're willing to put in the stock market long-term and not touch for at least 5 years, you should invest all of it. What to invest in? If you're new and you're a beginner and you want to start researching, that's great. But for the majority of younger investors, investing in a passive portfolio of diversified ETFs or individual stocks that diversify across the whole index is typically your best bet. Investing in life insurance. I keep seeing videos about investing in life insurance to make you rich. I see those as well. But can someone please explain this baby style to me? I thought life insurance only pays out when you die. So yeah, that's great for your family, but it doesn't really make you or anyone rich. Well, there's different types of life insurance. So there's term life insurance, which only pays out when you die. It's typically for a term, right? You get life insurance so that if you pass away in the next 15, 20, 25 years, your family gets paid out on that term. For the long-term outcome that's a little bit more guaranteed, which is investing in this life insurance bucket, that might make sense. But I don't recommend it to a lot of my friends. When I have people call me and ask me, hey, what type of life insurance should I get? And should I get term or whole? I always lead people to term for the most part, because the extra money that you are gonna be paying to that whole life insurance policy, why not just buy the term policy, put the rest in an investment portfolio with a low cost brokerage? You're gonna save on the fees, and then you're likely gonna get the same or if not similar returns as you would in that life insurance policy. Thanks for watching. This is Tony from Wealthfront. If you like these type of videos, let me know in the comments.